Welcome, everyone. I'm Rebecca Wallenfelsz, a partner in Chapman Cutler's Trust and Estates Group. I have a focus on estate planning, and in particular, I often focus on federal and state estate or inheritance tax planning. With me today is Mike Jankowske. Mike is the president of the Hamelind Group, which provides plan giving resources and strategies to professional advisors, donors, and not-for-profits. But prior to starting Hamlin, Mike was a financial planner who spent more than 30 years helping clients rethink their assets and their investments through a tax lens. And that's both an income tax lens and an estate tax lens to create what he calls tax diversification in those assets and those investments. So Mike and I did a previous episode where we talked about what tax diversification was. But for purposes of today, we're going to dive into one of those topics in a little bit more detail. But before we do that, Mike, do you want to say hello and tell us very briefly, for purposes of this recording, what is tax diversification so people have a base or foundation or a good recollection?
Well, very briefly, and by the way, thanks for having the opportunity to share this with everybody. Tax diversification just means that you start to partition your wealth between different tax categories or buckets, where the income tax consequences of putting your wealth into that bucket or category and the tax consequences along the way and out are totally different. But typically people are out of balance, and so therefore they end up paying more money in income taxes during their lifetime. So that's the broad definition of tax diversification, making sure you have the right amount in each one of the categories.
So one of the categories we want to talk about, which is one of the ones that's dear to me, one that I find a lot of my clients maybe have a significant amount of assets in, and that's the category we call tax qualified, tax deferred. So that's a mouthful. So Mike, why don't you tell us, what does that category mean?
Well, it's it's in the broadest sense, to keep it simple, because there's so many nuances associated with this category. Simply put, when you contribute money to items that are in this category, which include 401k plans, IRAs, what we call 403b plans, simplified employee pensions, typically what happens is you get a tax deduction or break putting the money in. You can invest in whichever way it's allowed. The growth of that investment is tax deferred, or what I'd like to call passionately postponed. And at some point in the future, when you withdraw money from that, you're taxed at a normal income tax rate, regardless of how you invest it. That's the broadest term definition of what's in there.
Yeah, and I think that's a good point to make is when people think about their retirement plans, they're like, hey, this is growing tax free. That's how often we talk about it, but it's tax deferred, not free.
Yeah, that's one thing, that the sticker shock of what happens when you postpone taxes inside of this particular category is a little bit of an eye opener for people I've advised in the past, including professionals.
Yeah. So since you talked about, the goal of having tax diversification is to have enough, but maybe not too much in any particular tax bucket. How much should there be in someone's tax deferred, tax qualified bucket, or i.e. in retirement plans?
I'm glad you asked that question, Rebecca, because inquiring minds want to know that all the time when I broach the subject of tax diversification. I don't have a simple answer, but I will say this. There's a specific amount of money in this particular category that you should have based upon your own personal circumstances and how you're going to cash flow your goals long term. And so it's not an easy answer, but it is too customized, where you have to have the opportunity to assess what circumstances you have financially that would dictate how much money should end up in that particular tax category. And I would rewind. The way I would approach this is the good, bad, and ugly about what happens when you don't have the right amount in. That's the key there.
Right.
And the way I'd like to address that is that I wouldn't want to work backwards, working from the perspective of a retiree and explaining the opportunities and challenges there, and then go backwards over time, all the way to the beginning when somebody starts to accumulate money for what they want to accomplish in that particular tax category. And then we're going to leave that going into the middle stage of accumulation, which Rebecca is arguing with me in a prior discussion whether she fits in that category or not. She mentioned she was on a downward slide going towards retirement. I have no idea what that means, but that's okay. But let
It
me
means I'm
go.
reaching towards retirement.
Oh, I see. Hand gestures. I like that. Okay, so let me talk about some of the, I'm going to call consequences. I'm not trying to be negative here. If you have too much money inside of a tax qualified, tax deferred bucket, you're probably at retirement or real close to retirement. Okay. And so here's what happens. If there's too much money in, okay, you're in a period of time where between the time you are going to be using the money from that bucket to the time that you'd be forced to take money out of that bucket, okay, you're going to be challenged with the amount of income taxes you're going to pay, uh, whether you're forced out or not. And typically speaking, people pile enough money in a 401k plan, IRA in this category, where what happens is they are never going to spend all their money in that particular category. They're going to be forced to take money out in what I describe as you're being forced to pay income tax on money you're not spending. And then they've got the lovely option to try to leave that to the next generation, which I call the squeeze play. And Rebecca, how much time period, I'm testing her, how much time period you have as a non-spouse to get all the money out of that tax qualified, tax deferred bucket?
The best you're going to be able to do is 10 years. And depending on how you set up the plan and when the person dies, you may be even limited to 5 years.
Yep. So now, because you overstuff money in there, you're passing along a major tax burden to the next generation on top of paying more income taxes you'd like to spend. And I've never yet have a client look back at me and said, and I quote, "I'm really happy that I'm forced to take all this money out of the IRA and pay taxes on it." Okay, that's really not the typical response I get from people. But with that is it caveated all kinds of different problems, because if you have too much money in that particular bucket and you got to pay for major medical expenses, you are probably forced to withdraw money from the bucket, report the income, and that eliminates the ability for you, or reduces the ability for you to take a medical deduction if you itemize, because you're limited to 7.5% of your adjusted gross income that you can take as a medical deduction to begin with. So anything over 7.5% of your income, that's a medical deduction you can take. Anything below that's less. You just basically blew up the ability to take that deduction. So with all, those are just examples of what consequences are happening there for somebody that overstuffs. If they have the right amount or have less money in, you have more maneuverability. So for example, if you are going to be cash flowing and let's say that you're not going to have many other sources of income, and your primary source is tax qualified, tax deferred product inside of that, like a 401k or IRA, you can have over the age of 65 well in excess of $30,000 you can take out of an IRA, because your standard deduction is going to exceed $30,000. Now, it may not eliminate taxes, but you can basically be almost tax free taking $30,000 out of your qualified plan account, the tax qualified bucket, and that has little or no consequences. Now, that all changes when that number ends up being a forced distribution of 50 or 75 or 100. So if in the right space, you can carefully and tactically cash flow money out of an IRA. So there is a proper amount of money to have in the IRA or 401k plan. So the question is, I wish I could tell you there was a generalized answer for that number as you're asking. Not going to happen. So again, it's all specific to how you accumulate, how you're going to cash flow from other areas. I will say this, if you're properly diversified from a tax perspective, it gives you the capability of being able to keep an IRA at some level and cash flow money out of it under favorable circumstances.
And there are then opportunities that might be available for how you can leave this as an asset to descendants. That's where planners like me come in. With certain strategies we might be able to implement too. Again, with this tax focus is what's the most tax efficient way we can leave this asset.
And one example of that has to do with creative cash flowing. Before I get to the youngsters in the crowd, rate of cash flowing means, I'll give you one example to kind of get the point across. Excuse me. In my past and working with clients, now I advise for everybody in my new space. Typically speaking, everybody knows, or at least they should know, for every year you wait past normal retirement age for Social Security purposes, at least currently, you pick up 8% more benefit. You can't beat that anywhere. So if you can wait 3, 4, 5 years to take money from Social Security, the big question I get is, where do I come up with the money to cash flow until such time I receive the Social Security? Well, if you're in that 30,000 per year standard deduction space, you can tactically withdraw money from a tax qualified tax deferred bucket to help cash flow your needs while waiting to collect Social Security. And therefore, you're way ahead of the game from a cash flow perspective and also from a tax perspective. Because bonus, unfortunately, too many people pay income taxes on Social Security, and too many people, and on top of that, if it's too large of a scale problem, they'll pay an insane amount of penalties on what I call a Medicare surtax because of what they're forced to take out of the IRA. So those are some examples where you can be a little bit more tactical at retirement age. That deals with what I call damage control. And but again, moderation in that and understanding where you need to go on that. For somebody that's at their retirement age, it might be the idea that you want to basically reduce the amount of money you have in the tax qualified tax deferred bucket. Stay tuned for examples of how we can do that in a future video and put it someplace where Rebecca personally would like to go, which is the
Yes, it
tax
is.
exempt bucket. But
Yeah. So with that, now let's go talk about younger people because we've talked about like retirees and the position they may be in. But if I'm a younger person and looking at, thinking strategically where I want to accumulate my income, how do I want to approach looking at a tax deferred, tax qualified bucket?
well, interestingly enough, there's an old adage I use, or story I talk about when people look down a railroad track at the close end view, when you're right there, you can see pretty much what's going on. And as you look down the railroad track, you can't see too much of what's going on. You need a way to expand your view on the railroad track of your financial security, which means you want to be able to have an assessment tool that says, based on what I'm doing right now, am I going to create the same kind of problem the people that I'm helping out with damage control are going to happen to you because you're pounding too much money in. So the key here is wrapping together an assessment of having to look at what happens to the cash flow needs for what your circumstances are, adjusting for inflation, show you what happens with the income taxes along the way, along with what happens at the back end. And that's an eye opener. Nowadays, there are more people who are youngsters, for lack of a better description, are more in tune with that idea. They kind of get the idea that there's too much money that you could have on a qualified retirement plan, which is the tax qualified tax deferred bucket. But they don't have that quantified enough to know what's the best fit for them. So ideally you assess, then you turn around and adjust what you put in. And there's all kinds of tactics you can do to massage what's going along the way, which gets into your category. Now, if you have too much or too little in that middle stage
Right.
that you're talking about.
Right. So as that middle stage person, it's getting the assessment at that point. And do I need to pivot? Do I need to adjust? Do I need to do transfers? Do I need to make different decisions?
Yeah, you do have options. They may not be within the qualified plan account that you have, whether it's a 401k plan or an IRA, but I will tell you that there are options. And the key here has to do with legislation. I will say this much to tease you for the next video, okay? For years, before they even had a Roth IRA, I was helping clients find a way, because they over contributed to a tax qualified tax deferred category, taking money out of that plan without paying the excruciating amount of taxes and reallocating it somewhere else where they wouldn't get hammered so much tax wise. And they would always look at me when I would help them find a way to get the money out of that tax qualified tax deferred bucket and say, well, you helped me to offset the taxes getting the money out enough. What do I do with this money? And I had answers, but they weren't as good as the quote Roth IRA. Okay. That's been a godsend for a lot of people who would start to understand how to be more diversified from a tax perspective as one component.
Wonderful. Yeah, yes, great. And we'll have those videos for you. And when we talk about, maybe moving money from one bucket to another bucket. So, Mike, any final thoughts on this tax diversification category of tax qualified, tax deferred?
Yeah, I can't emphasize enough that you have to have the right collaboration and the right planning tool, because it's not just a decision that you'd make with a financial planner. It's, to me, you have to combine the collaborative intelligence or intellect of your wonderful estate planning attorney, whose name I shall not mention.
And if you're
You,
lucky, it's Rebecca Wallenfelsz.
I think you'd have more than luck going in your favor. How's that for a promotion? Testimonial for Rebecca. But I think you need to have that collaboration between a CPA, financial advisor, and an estate planning attorney to coordinate using a planning tool that accurately assesses what's going on in the big picture from a holistic perspective. So it's a combination of those things that are critically important to be able to have some vision and more refined vision of looking down that railroad track, so that you can actually feel comfortable making decisions to make those adjustments, whether they're on the front end, unfortunately with damage control on the back end, or what I call tweaking along the way. So that's my final thought. Get a chance to find a way to assess. Don't take anybody's advice individually. You need a good proof source that can take your personal circumstances and really understand where you are going in the direction you are going in that tax qualified, tax deferred bucket.
Yeah, that's wonderful advice. Thank you so much, Mike, for joining me today. And be sure, everyone, to tune back in for other videos.
Thank you very much for the time. I look forward to enticing you with the other buckets in future sessions. Thank you very much, everybody.